Earl, what was your take on Powell's remarks, especially given the positioning that we saw yesterday heading into these comments today?
Yeah, unequivocally dovish. And I don't think that was too much of a surprise to the market in regards to confirming the data that we've seen. But the importance of today's number is that it turns the full focus to employment. Inflation is no longer in the crosshairs, at least from a short to medium term. It is fully on inflation. So I think that makes it easier to judge where rates will go going forward.
What he didn't say, though, were the words like methodical or gradual when it came to cuts. Does that mean to you the door's open for 50 in September?
Yeah, it definitely does. And it all depends on one thing. That's the unemployment rate. So the way we are looking at it, we added to risk today, duration, but we're 50% of our max risk. The way we're looking at it, our base case right now at 4.3% unemployment is 25 basis point eases going forward. As soon as we hit 4.5 to 4.5 and in between 5, it moves to 50 basis points. Not necessarily every meeting, but the next meeting after we see a 4.5 rate will be 50 and maybe intermittently the 25, 50, 25. If we go above 5%, then it's 50 basis points hikes. And the target right now is 3% in our eyes. Unless we have some recessionary fears, then it could go below that.
Okay, you say the key data point will be the jobs report, and that is on September 6th. That's still another 2 weeks from now. So what are investors going to do from now until then? What are traders going to do from now until then?
That's a great point. So I heard you say earlier, someone say slow to low. We do believe it's a grind lower, but it's not slow to low. What will happen in between now and the unemployment reports is volatility. That was our highest conviction view for 2024, and it's played out and will continue to play out. The volatility will come from the election, basically. So on spikes higher towards higher rates, we think as 10-year yields spike towards 4% provides a great buying opportunity, as we do believe it is grind towards lower rates from here.
So Earl heard me talk during the break because I kept talking about, we're going from higher for longer to slower to lower.
That's what she was saying, and I was talking about Deadpool. So I think that just perfectly encapsulates Scarlett and myself. So Earl, if I take a look then at the 2-year, 3.9%, clearly the market is going to be buying all across the curve. I was mentioning earlier that was severe weakness there in the dollar over the last 5 weeks. Is that all justified? Does this all make sense to you?
It does. Maybe it got a little bit ahead of itself in regards to discounting 100 basis points, but it doesn't mean that all of the discounting is done. This is the reason why you'll get slow to low, because of how much is discounted in the market. But a key thing to remember, you heard Hawker this morning in regards to saying neutral is 3%. That means they could ease rates from 5.30 to 3% without being in an easy state. So from our perspective, we actually prefer being long 10 years and 30 years. We think there's less volatility on being long there, and we like that it's above inflation and above the neutral rate. But nonetheless, this applies for the whole curve in regards 3% just gets you to neutral. If anything happens, a significant extended risk off, unemployment goes above 5%, you could easily go below 3%. And I think it speaks to where the Fed put could go as well. So here, I wouldn't be all in risk, which is why we're not, but we have a significant amount of risk in regards to half our max risk position.
What about on the corporate credit side? Do you expect a flood of issuances now that Powell has made clear it's a go in September?
I wouldn't say a flood, because it will be the slow to low, as you put it. So because of that, you could issue as you would expect. Having said that, we do expect issuance to be robust, given where rates were over the past 2 years. And we do expect, and we do like credit overall. Having said that, we are reducing our credit positions at this level just because of the valuations, but we're staying long. And the reason why we like credit, this definitive statement about eases are next, says, you know what, no matter what happens with the economy, they're going to try to prolong the great state. That is good for corporate credit.
Yeah.
It pushes forward the default cycle. Yeah.
Sure, and also just, help that soft landing scenario, which they seem to be at the moment pulling it off. So before we let you go, and we take a look then, you're mentioning how the jobs data then becomes all that more important and how that's going to be the Fed's focus. What should the market reactions function now be to that data? Is this going to be a redux of what we saw early August?
So that's a great question. So how we're positioning ahead of that data, if we do get a stronger than expected data, as I mentioned, towards 4%, we will be buyers. However, if similar to the last data point where we got this 20 basis point move, we will reduce our long duration position. The reason is not because we don't believe in lower rates, but we highly, highly believe in volatility. And the reason why we're having volatility is that there's so many credible, probable outcomes on both sides of the equations. So there's a way to monetize that, and we're positioning ourselves to monetize that.